you can cripple economies financially. It's economics which will stop Russia from bombing Ukraine at some point.
This is what the Cold War is. They're just trying to completely tarnish anything that China does.
Donald Trump is trying to wrestle power from the Fed, right? He wants his own man in there so he can dictate interest rate policy. So that's dangerous. And if that then does happen, hello and welcome to The Market Edge. Now today we are talking about a brand new Cold War.
But this one isn't about missiles, it's about money, infrastructure, and the global stock market.
Now, Donald Trump has rolled out his big, beautiful bill. Now, this is $600 billion worth of spending all over the place.
And China, they're building railways, nuclear power plants, and highways at extremely fast speed.
We reveal why the geopolitical stakes are so high.
And how you could potentially benefit from the infrastructure arms race.
Now, let's get through this quick disclaimer. This podcast is for educational purposes only and is not intended to be financial product advice or any investment recommendation. Stay tuned for additional disclaimers at the end of the episode.
This is The Market Edge, so let's get into it.
Okay, so let's start with the tweet of the week. The big beautiful bill is just another huge transfer of wealth to the 1% in this country. Absolutely sickening. And the chart, as you can see, shows the share of tax cuts from House Reconciliation Bill in 2026. And it's basically showing that all the money's going to the richest people in the US. However, please tell me how this hasn't been the case in every political regime in every developed world for the last 50 years.
Well, I have a very controversial take on this.
That doesn't
and people are
surprise
going
me.
to absolutely love or loathe it. But
Let's go for loathe.
is there anything wrong with the top 0.1% or 1% getting richer while the median wage is also rising? I don't think it is, because what that's showing...
Is the median wage rising?
In the US it is, not the UK. The UK is completely bombed out and is going to the dogs, but that's another question. But the way that I see it is, as long as the top 0.1% is innovating, is taking risk, is allowed to build their businesses in productive means, so like actually building businesses, not just becoming like a property conglomerate or like a landlord or something.
Yeah.
While the median wage is also rising and beating inflation, I think that's a perfect scenario for an economy to grow. Whereas loads of people are saying, and I think rightly so with the UK specifically, the top 1%, top 0.1% are getting richer, but that median wage is being stagnant. In the US, it's rising.
Trump's point is you give 0.1% of the world, the country's richest people, companies, and it's not people, is it? It's companies.
Yeah.
Then the byproduct of that is the people will get richer. But if you give these innovative companies more money to innovate, they will innovate more, make more money for the economy, build the economy up, make the US stronger, blah, 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 manifesto, MAGA, blah, blah, blah. Right? That's the point. Is that not the point, right?
Yeah, absolutely. I just liked your little rap there. I think, but like, if we take Elon Musk, right, $2 trillion pay package that's meant to come.
Yeah.
There's some justification, and that's okay. He's built Tesla.
Well, he's done quite well, isn't he?
He's built Tesla. He flies rockets to space. He's got, is it Solar City? He's got the Boring Company. He's got the robotics stuff, whatever's going on there. He's got XAI.
Yeah.
Like, come on, man.
Yeah, see, and the situation here, now, even though Trump obviously hates Musk now, and
No, you know what? They were pally at Charlie Kirk's funeral thing.
yeah, well.
So they're all right now.
So, okay, so they're fine now. But
Yeah,
anyway.
They kissed.
You give, this is the whole point, you give money to someone like Elon Musk, who has, how much money has he generated for the US economy in taxes and whatever
Model Y was the most sold car last year still.
Now, let's talk a little bit about what the big beautiful bill is, right? The big beautiful bill, what it is Trump's spending plan, right? And it's this spending plan which is reigniting, we'll come on to this a little bit later, but is reigniting this next Cold War, right? Because There's money being pumped into US businesses, making US businesses bigger, better, and basically stronger than their Chinese counterparts.
Yeah, I think honestly, like that is the way that I see it. And there's a nice story, okay, that I'm gonna tell you, like a bedtime story now,
Brilliant.
James.
Settle yourself in. Settle in.
So back in the Cold War times, the US found schematics of a brand new plane that Russia was developing. And this plane looked to be the most powerful thing ever.
Yeah.
So what the US did was they started developing a plane that actually beat those schematics and that engineering. When they saw the schematics, this plane had the capability to like fly across the Pacific without having to refuel, which is insane. It was able to travel at speeds that were unheard of, and this, that, and the other. A Russian pilot stole one of the planes and landed it in Japan. The US were ecstatic because they finally had access to what an actual engineering marvel this was. When they found it, it was severely underpowered. It was pretty much rubbish, and it was okay for chasing US bombers, but not actually okay for competing against the current US planes that they had. Mm-hmm. So the US had just gone and just thought, okay, they're doing this, we're going to do something way, way better. This is the Cold War that's occurring now, is they're looking at China building, Shanghai, Beijing, Shenzhen. If you think of DeepSeek, they tried to compete with NVIDIA. Nope. Yeah. You go and get loads of funding in the US for all your data centers and all your chips and this, that, and the other. This is what the Cold War is. They're just trying to completely tarnish anything that China does. And they're going to do that because the US GDP per capita is about 88 grand. Yeah. China's is 12,500. I've said it multiple times on here. And so I think, this is really the Cold War now. It's in the tech space. And if we think about Heathrow Airport just the other day, what we found is that, they've had a cyber attack. So it's in the tech space and cyber. That's where all of this Cold War stuff's happening now. It's not actually on battlefields, maybe Ukraine, Russia.
Yeah, well, 100%.
But they're targeting corporations everywhere.
This is more so this Cold War is as you say, it's a tech Cold War. Now, from our perspective as traders, right, we will say, okay, we don't really care what the ins and outs of what's going on. Who cares? Where's the opportunities is what people will ask, right?
Yeah, exactly.
And we will come on to that a little bit later. But when you've got companies, there's two angles to this. One, when you've got companies competing with each other like they are, with China looking to spend aggressively to make sure that they're beating US counterparts or spying on them somehow, whatever. Yeah. The spend is astronomical that they will have to put in. So you've got economies like the US spending $600 billion on whatever this infrastructure is. China will have to spend whatever that is even more. Is this not just a fast track for them to... The Cold War was incredibly expensive. We're talking about the 80s Cold War, right? That was incredibly expensive. This is exactly the same thing. It costs these economies billions, trillions of dollars.
Yeah, but I think the difference is that it's actually in more productive assets, if you like. It seems to be that it's in sort of businesses that are going to power GDP. I think the Cold War was more of a weapons arm race, wasn't it? Remember, you had Russia moving
But
missiles.
That's just a technology point. That the whole thing, weapons were the 80s AI, right, if you like?
Sort of, yeah, but I mean, Russia moved missiles to Cuba, for instance, had the Cuban Missile Crisis and things like that. So it was much more aggressive on that front. Whereas this is more domestic to just take away market share from elsewhere. I think even if you look at NVIDIA and how they get chips to China, the US are going to be happy with it. They export them to Singapore then sells them to China, even though there's a ban, right?
Yeah.
And so really it's just a lot of face saving, a lot of posturing, I think. Whereas with the Cold War, I think there was an actual credible threat of like, yeah, we're going to bomb you.
Yeah. But now they just don't need to do that.
Nah, exactly. Well, the US doesn't anyway.
You can cripple economies financially. And you look at how the world is focused. You look at how the world tries to stop Russia. They're trying to stop Russia attacking Ukraine economically.
Yeah.
It's the only way you can stop them is economically. Make the people as poor and as miserable as they possibly can without actual any sort of attack happening. So it's economics which will stop Russia from bombing Ukraine at some point. Not any sort of military action, it's going to have to be economics, because it all comes to a power perspective, right? You have, if the electorate are hungry, poor, and miserable,
They're gonna
they
fight.
don't vote for the person in charge.
Well, I guess
you're talking
Putin's
Russia.
a bit of an autocrat, isn't he?
Yeah, but that's the idea, right?
Yeah, of course.
But and if they can't then vote that person out, they rise up.
Yeah.
You get unrest in that country. So that's economic sanctions for you. Because a lot of times we hear economic sanctions on the news, and the word's bandied around, or we hear sanctions on this person, on that person, and you can very easily think, well, what the hell is that going to do? But it is economic warfare. That's what you do.
Exactly.
Anyway, we'll come on to a little bit of that later on about how you can trade on the back of this new Cold War and what companies are going to do. And actually, it lends quite well into our picks for the year. Yeah. Almost like we knew what we were doing.
Really well.
Let's look at the markets. So we'll look at what's happened over the last couple of weeks since we were last on. Mm-hmm. It's been a big week. We are September the 20-something. Last week we saw interest rate decisions. So it was a pretty pivotal week last week for US rates. Now, we saw Jackson Hole a few weeks earlier hinted at September rate cut. We knew September rate cut was coming. September rate cut came. What the interesting term from Jerome Powell was he said they basically had to make this rate cut because of the markets, but there is pretty much no room for another one. Now, the chart that you can see now is the dot plots. Now, dot plots show you, they try and predict where members of the FOMC are going to vote in terms of interest rates. Now, this points to only one more rate cut in 2026. Whereas, as a lot of key members, and more importantly, the Trump members of the Fed, who are voting for 3. So that divergence is going to be a big issue for the Fed and for markets.
I think it's well underpriced in terms of lower rates, in my opinion. I think the US is containing inflation relatively well. Mm-hmm. It's in a bit of a disinflationary move right now, which has no bearing on deflation. It's not as inflationary as before.
Yeah.
And also the labour market is definitely an issue as well. So I think that is really where there's cracks starting to appear, which would lead to further rate cuts coming in. And so the interesting part about trading this really is how might you express this view in FX, for instance? Might it mean that something like dollar yen weakens even further?
Yeah.
I'm not so sure, only because of the current hedging that's gone on since the start of the year in FX, especially against the dollar. There's not been outright dollar selling. It's just foreign nations, foreign firms, foreign investors have decided to increase their hedge ratios against the dollar.
Yeah.
So if they unwind those,
yeah,
based off of this new monetary policy movement, if interest rate volatility increases a bit, it's actually probably likely the dollar strengthens in a weird way, whereby interest rates come down, but the dollar goes back up.
Yeah, let's cut this down to a little bit, proper layman's terms here. Obviously, we talk rate cuts. They're positive for the stock market and negative for the US dollar, right? So that's what we see. So what we're talking about there is that the potential of this dollar going up on the back of these rate cuts, which is not how anyone would look to trade. But when you're looking at this divergence, it's where we then sit in the middle. Now, what is going to be really key, and we spoke about this before, is Jerome Powell's tenure comes to an end in May. Mm-hmm. There will be an announcement of who's going to be the next Fed chair. Now, Donald Trump is trying to wrestle power from the Fed, right? Even though it's not widely accepted, you're not allowed to do it, blah, 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 blah. Central banks are independent. He wants his own man in there so he can dictate interest rate policy. So that's dangerous. And if that then does happen, if Trump gets a Trump ally in the Fed, you forget one rate cut. These dot plots change instantly. And you look at definitely 3 rate cuts next year. And there's only one reason for that, is because rate cuts give people more money in their pockets, meaning voters are more happy about the state of the economy?
I'd I'd say so, but I think in this case, I think it's more dependent on the corporate side of things, only because we can use the UK as an example. Interest rate cuts here are much more important to the everyday UK person because homeowners fix their mortgages for a much shorter period.
Yeah.
In the US, they fix from 15 to 30 years. So
Yeah,
obviously,
what we hear, 3 to 5 years.
well, one to five.
Yeah.
You know, so I think in the US they're largely insulated from interest rate volatility on the upside, purely because of that, you know, the nature of how their mortgage products are structured. But for corporates, they haven't necessarily hedged their interest rate risk from 2022 when it started increasing. So there's another interest in play there where you actually look at really high debt companies with unfixed hedges on their interest rate risk for their margins to actually thicken because the cost of their debt comes down.
Yeah.
So companies with really, really high debt, you normally wouldn't really want to buy.
No, but if their debt's about to get cheaper.
Exactly. And so that's where I think it would benefit the US economy and not necessarily the US consumer maybe.
Yeah.
But it depends how, you know, leveraged the US consumer is. Maybe they got a ton of payday loans or something like that.
Yeah, of course. But the situation, see, and this is where I think we break this down. People, you hear interest rate decision, and from a trader's perspective, they just go, oh, market move up or down.
Yeah.
Let's look at dollar and the S&P. You take the piss out of me every time I say Dow, so I say S&P. But let's look at the S&P and the dollar, and then that's my movements on the back of the so short-termist.
Yeah.
But what interest rate cuts mean is they mean debt payments are cheaper. Means not just individuals have got more money, but companies have got more money. So let's look at the trade noses. Let's go back to the Cold War. Now, not the 80s Cold War, the Cold War we've been talking about. So there are 3 companies here. Well, there's 2 companies and there's the dollar.
Yeah.
Dollar yuan. Now, if we look at the companies first, there are 2 major ones here. Now, Caterpillar ties in a little bit with the strategy we've spoke about for quite a while. We did an episode, I remember, it was like, you know, how you get things from your watch list into your portfolio. And it was about, you know, looking at last transactions on your bank statement, seeing where you spend money, like who these other people spend money there, companies doing well. Well, similar situation with Caterpillar is drive down a motorway or a freeway or whatever in any country, drive past any building site you ever see, you will see Caterpillar products.
That's somewhere.
Somewhere.
You know,
In pretty much every country in the world.
if it's not a JCB digger here, it will probably be a Caterpillar, like an excavator.
Anyway, so that's Caterpillar that's doing well. Now the other one, Newmont.
Yeah,
Tell
love
us.
Newmont. Gold miner, one of the biggest gold miners
We spoke
in the
about
world.
this last week as well in our gold episode, right?
Yeah. It's gone higher. Obviously, is my idea.
But look at the charts. Look at the charts. Very simple. I mean, Newmont is a gold miner. It's going up because look at gold's at all-time highs again, is it? I don't know, I haven't looked at gold price.
It doesn't stop.
But all-time highs
stop.
continuously. It's not just these stocks. It's other stocks. It's Google. It's tech stocks. It's Nvidia. All of these stocks are being fisted with US dollars by the big, beautiful bill, you know, to make sure that they're spending. So the picks that we made from the start of the year, 3 stocks, Rolls-Royce, Walmart, and Tesla. Let's start with Tesla, because Tesla had a sell-off,
Yeah.
but has, of course, since recovered. Now, it was in February we picked these, I think, start of Feb. And Tesla is now up solidly,
Yeah.
probably slightly above where we said, where we started, so into positive. Just to show that we're not just picking out, you know, just the stocks that
We've
made.
still got 3 months for this to be
Yeah.
a fantastic
End of year. Yeah.
end.
Rolls-Royce is a joke of a stock. I mean, Rolls-Royce is ridiculous.
Oh, that's why I picked it.
Yeah, it's just flying, absolutely flying. Great performance from that perspective. And Walmart. Now, look at these stocks again and go back to what we just said about Caterpillar. These are at the fabric of general life in the US or wherever they're based, right? Walmart especially. Walmart is on the corner of every US street, you know, billions of dollars being pumped through it all the time. And again, going back to the strategy you said before, looking at your bank statement, if you're in the US, your likelihood is going to see a lot of Walmart transactions.
Yeah.
There you go. Rolls-Royce. Rolls-Royce was an interesting one, but if you travel anywhere on an airplane, it's got a Rolls-Royce engine in it.
Rolls-Royce engine, yeah.
So, and they're still building planes all over the place.
Yeah.
So, Rolls-Royce, another one. Now, Tesla was a different one because it had that situation with Trump, Musk. Knew the election came, everybody was all over the place. So Tesla was all over the place.
Yeah, I want to break it down into a little bit of a different context because you're absolutely right from that thematic view. But if we take how I thought of these at the start of the year, so Tesla moves at a massive beta, so massively outperforms the S&P 500 when the S&P 500 is moving up.
Yeah,
that's one of the reasons why I picked Tesla. Wanted that outperformance. You could see when we had the April issues that it absolutely dived, and now it's making its comeback. Rolls-Royce, I've been long since 2020, and this was the one that I was really looking for that continued outperformance from.
I mean, that's ridiculous.
It actually has. And then Walmart, what I was looking to do was smooth over some of the volatility across the entire portfolio. Yeah, because Walmart trades at sub 1 beta to the S&P. So you can see there that it trades quite flat compared to the others. Yeah. But it's there for a reason to actually make sure that when you do have the bad times, if you like, your portfolio drawdown isn't as harsh as it would be if you were to have had like another tech stock in there, for instance. Yeah. And so that's really how that composition occurred. But again, what I look for is P&L, most of my profit to come from pretty much 1-2 stocks out of the whole portfolio, like 70 to 80% of the profit to come from it. Like in terms of outperformance profit, that is. Yeah. And for me personally, Robinhood, Rolls-Royce, and also, oh God, I can't even remember my own portfolio now. Robinhood, Rolls-Royce, and GoDaddy have been the 3 companies over the last 2 years that provided me about 74-75% of my profits.
But I mean, and you can see why, because they keep going up.
But I just wanted to have a quick mention on the FX side of things. So we focus quite heavily on stocks. Now, stocks are inherently something that tend to go up over time, especially at the the top end of the S&P 500. FX is a different beast entirely.
And retail traders love to trade it.
Yes. FX is very mean reverting. Yeah. So it's a different way of thinking to stocks. You can't just be long euro dollar forever, for instance, whereas you probably
you can.
I mean, you can.
But very unwise.
But you're going to be affected by,
I mean, this is not trading advice in any way, but I wouldn't do that.
No, exactly, because it's a mean reverting asset class. When you're long one currency, you're short the other one. Yeah. Right? And so taking the view that FX trends is probably not the best view to take for that specific market. Yeah. And the reason why I like stocks is because you basically have unlimited upside, potentially. Yeah. Right? It can keep going up. There's some stocks that I've looked at that got listed in 1967 and have literally just gone like that. You've never heard of them before, but they're probably $50 billion in market cap, listed on the New York Stock Exchange, and they've just done the same thing for the last 50, 60 years. Yeah. FX, you've got to pay attention to so much macro that is largely unseen. And so from that perspective...
forget just your non-farm payrolls and everything else. You know, there's a lot of other stuff.
Yeah. And what you're looking at from that perspective is that it's a mean reverting asset class. So the one thing that I want people to take in terms of trading education from this is focus on building a strategy within FX that is around mean reversion and not around trending like you would with stocks. Yeah. Because that is absolutely the easiest way to build something.
You cannot have the same trading strategy on both asset classes. No. Now you can from it. Technical analysts will turn around and say, well, it actually doesn't matter what the asset is. No. That's why they...
But the thing is with, you're then looking at stuff like carry. Can you create a carry strategy in FX? That is really where the trend starts from. And I would argue that a lot of people don't necessarily have the capability to create the adequate carry strategy, hedge at the right times and things like that. So that's my view on it. That's why I don't trade FX anymore, because I like to just buy something and it just goes higher.
Because you like to make money when you trade.
Exactly.
And I think on that bombshell is where we say, are you scared about a new Cold War? And if you're not and think we're talking rubbish, then let us know. If you think we're talking sense, then also let us know. But whatever you do, like, comment, follow, subscribe, and all of those things. And we'll see you next time. This podcast is for educational purposes only and is not intended to be financial product advice or investment recommendations.